Markets came into Monday with a positive tone, and it's driven on last week's news, that weak jobs report. That miss has investors betting hard that the Federal Reserve will resume cutting rates, and that's lifting sentiment due to the expectation of rate cuts come their September meeting. But under the surface, there's a lot of moving pieces to what's going on. We got articles on ETF flows today, big tech dominance, trade deals, factory data. We'll even talk about Trump's latest tariff moves. Let's break it all down. So first, ETF flows tell us a lot about where investors' money is going right now, with US listed ETFs pulling in $121 billion in July, putting 2025 on pace for a record $1.3 trillion in inflows. So that's definitely seen as a risk on mood or sentiment in the stock market, but it's not a full-blown greed environment yet. We've looked at that fear and greed index, and we've been sitting steady in that chart for quite a while where we lie on that. Just look up fear and greed index. But small cap ETFs are actually seeing the longest stretch of outflows on record. Sentiment has cooled dramatically from the extremes we saw months ago, but I don't think that means we've hit peak optimism necessarily for this bull market. Historically, euphoric peaks often come months before the final market top. So we'll just keep on watching, but with people getting out of these small cap stocks and they're still piling in the ETFs, but small cap companies aren't getting the love, there may be some limit to how high this rally could go, or where the people are positioning their money just leads a tell here. But let's talk about these Fed cut expectations. So now here's where the big shift has really happened in the stock market, and it's due to the Friday jobs report we just got on Friday, with 73,000 jobs in July being created and that they let us know about, which was far below the expectations. But that wasn't all the bad news, though. The bad news was mainly along the lines of the revisions we got in May and June, together erasing almost 300,000 jobs. I believe it was around like 258,000 jobs from prior reports that just disappeared and were never there. That's the weakest print we've gotten since 2019, and it's exactly the kind of data that the Fed would need in order to support rate cuts as an entire board. The conference board's employment trends, on the other hand, dipped to 107.55 in July versus that 108.19 we got in June, showing some cooling in the labor market conditions. The share of consumers saying jobs are hard to get also climbed, being the highest since March of 2021, lying at 18.9%. Jefferies now sees a roughly 7-week window where the economy could face this weakening labor market with limited Fed support until that September 17th meeting, when a lot of people are expecting we cut rates, which you could see right here, 90.4% chance the Fed will cut. And it's a strong chance of this 25 basis point cut or a 0.25% cut from where we're at right now on the current Fed funds rate. Now, this one was interesting reading about because it was talking about how earnings season has actually been better than expected. 2/3 of S&P 500 companies have reported, and 85% have beat estimates, which pushes the forecasts higher, and historically stocks tend to follow earnings. But Jefferies is sounding to note that they're possibly, you should probably just be a little bit cautious on big tech. It's not calling for a crash or anything, but it now makes up 44% of the S&P 500's weight at an all-time high. And they're not calling a bubble, like I said, but they do see valuations just a tad bit stretched, and the trade getting long in the tooth is how they describe it. Rate cuts are historically what helps the broader market move in tech, which could shift leadership, assuming things continue to progress towards these rate cuts. Now, the factory order set. Oh, I didn't mean to have this on blue right here. So what we've seen with factory orders is that they fell 4.8% in June, driven largely by transportation. Excluding transportation, orders actually rose by around 0.4%, and overall it's been 2 declines in the past 3 months, which is a sign of slowing in the manufacturing momentum. And think about manufacturing as a lot of jobs in that industry, which is why it even matters what the manufacturing space is doing in the US. Now, more so on the trade front, the US and the European Union reached a deal to suspend planned retaliatory tariffs. The European Union will invest that $600 billion into the US and buy $750 billion worth of US energy products, and I believe agriculture was also on the list. And that deal sets a 15% baseline tariff on most European Union imports to the US. Think like your wine, for example. But meanwhile, on another front, Trump says he'll announce his replacement for Fed Governor Adriana Kugler, who resigned unexpectedly last week, not really giving us much information about the reason why. She skipped a couple meetings or skipped a Fed meeting, which is unusual for Fed members during these times, and she wrote this letter to Trump and announced that she was resigning this week. So that's important because this could shape the Fed board's tilt on rate policy, because now Trump has control of another seat. So he has Chris Waller, he has Michelle Bowman is the other one, and then if he's able to nominate another governor, Fed governor, or somebody on this board, that'll be 3 seats right there. And then not to mention Jerome Powell's term, who ends in, I believe it was May of 2026. But let's just continue, because we got more tariff news, and this will be more so on the front of what's going on with India. Oh wait, I think it was this one. I was on the wrong article. So this article was meant for when I was talking about Adriana Kugler, and this is for the what's going on with these tariff news. So India is in Trump's crosshairs for buying Russian oil. He made this long Truth Social post about them buying oil and currently facing this 25% tariff on its exports to the U.S. India could see these rates further rise because Trump said that, and he didn't say by how much they could rise, but he's framing it as both a trade and geopolitical move tied to Ukraine. And pretty much what he's saying is, hey, oil purchased by India from Russia is supporting this Ukraine and Russian war, where there's a ton of Ukraine people being killed. You're pretty much funding the war for Russia, giving them your money for their oil, and they're using it to turn around and buy weapons and go kill a whole bunch of Ukrainians. And because you buy oil, India, you support this, and because of that, we're raising your tariff significantly from there. So, I mean, today, just keep on moving. Like I said, there's a lot of pieces. So here's the big picture. Friday's job miss has completely shifted the conversation. What investors were pricing and analyzing, and all of their expectations were built upon this data being somewhat accurate. But now that there's this question about how reliable this data that we've been getting, it's making a lot of people redecide what they necessarily need to do, hence shifting the conversation. Then rate cut odds for September have spiked. Due to this, the labor market seems to be weakening significantly more than people were thinking it was based on private data sets. And this is fueling this market optimism, which Fed cuts will help businesses, and it's better for consumers, I guess, too, because they're able to borrow money cheaply. But they don't really impact the end of the curve. They only impact the front of the Treasury curve. But we're heading into late summer with stretched big tech valuations, uneven economic data, and active trade and tariff backdrop that's constantly changing. And this rally has momentum, but it's navigating a minefield of risks. So I'll try to get out tomorrow's video a little bit earlier today. I just had a whole bunch of stuff to knock out before I recorded it. Maybe this is a cooler look for the video. I don't know. Let me know in the comments. But yeah, moral of the story, I won't be late tomorrow. See y'all later.